Now, South Africa's interest rates have remained unchanged for a fifth consecutive time last week, with the repo rate at a 15-year high of 8.25%. But relief is in sight. The Bank of America expects rates to ease by 25 basis points at the September and November meetings this year, as well as in January and March next year. Tatonga Rusike, who's Sub-Saharan African economist for the bank's Global Research Unit, joins us now with a closer analysis of these expectations. Tatonga, thank you for your time and a good afternoon to you.
Thank you. It's a pleasure to join you.
I will tell you, as a South African and I guess as anybody who's battled through this inflation spout that we've had, it's very hard to get excited about interest rate cuts because we then thought at the beginning of the year that we'd be cutting already, and then it's kind of moved back, and then it's moved forward, it's moved back. Let's talk about September and the prospect of a September cut for South Africa.
Yeah, look, I think inflation forecasts becoming better, particularly into year end. So for the third quarter and fourth quarter, inflation forecasts are suggesting that they'll come into target. And the central bank, I think, for quite some time have been hawkish, emphasizing that they would look and they'll consider cutting interest rates when inflation is close to target. So it sounds like we are getting there, and probably that relief will be coming sooner rather than later. So that is because domestic inflation is becoming better. But also we've just come out of elections. And for markets, elections produced a good outcome that you see being reflected in the currency. The rand has been stronger, closer to 18 than the levels of around 19. So this has passed through to prices as well, particularly for things like fuel as well as food prices. So that has moderated and helping some of the inflation forecasts that we're talking about will come close to the target, which is what the central bank has been looking for.
Also, what's interesting here is we do have a school of thought that I think that it would be completely impossible for South Africa to cut before the US. And I'm keen just to get your thoughts on that one.
Absolutely. So there are two things. One is if you cut too fast, when others are not yet cutting, particularly the global central banks, that it can tend to have a negative effect on the currency through excessive exchange rate depreciation that feeds on negatively onto inflation. So the story, I think, with the US Fed is that signals as far as inflation is concerned is that it is coming into target. So cuts are possible. I think markets are already pricing in potentially a September cut from the Fed. At Bank of America, we're not yet convinced that the Fed may start cutting in September. We think that economic data is not yet cool enough to give those signals, but it's possible. So when a September cut comes into play, at least for the Fed, it gives more room for the sub. At least from our perspective, that domestic data is pointing towards cut. It can be better if the Fed also starts cutting in that respect.
Also interesting here, and I'm keen also to get your thoughts. Obviously, South Africa, of course, was hailed as a central bank that responded quickly ahead of the curve to inflation. Have we benefited from that, Tatonga? Many schools of thought also think that we've actually broken our economy, in the interim, of course, because of our low growth prospects. But did we benefit from getting ahead of inflation?
I mean, absolutely. Inflation peaked just around 7% in 2022, and it didn't increase beyond 10%. So you will see many countries in Sub-Saharan Africa that have struggled with inflation above 20%, inflation above 30%. So keeping inflation lower into single digits has actually helped stabilize. It's not so much about, I think, the negative impact on the economy, because perhaps that channel onto the economy is weak. I think there are other structural factors that constrain growth of the economy. South Africa has been growing plus minus 1% for many years, pre-pandemic and post-pandemic. But we are looking at more in the sense of broader reforms. We have the lights that are now on for much longer, since I think more than 3 months now. That helps to have a positive view on the economic outlook. What the central bank can do perhaps with the cutting cycle is that you start to see I think, more money into the pockets of consumers through lower debt servicing when interest rates decline. So household consumption can also start to add more positively, I think, to growth, but not necessarily the fact that rates by themselves constrain GDP growth. I think there are broader issues that affect GDP growth beyond monetary policy. So we are constructive on growth outlook because there are many things that are taking place as far as broader reforms are concerned.
We, of course, know that repo rate currently at 8.25%. When we start to see cuts, how deep can those cuts realistically go, Tatonga?
Yeah, so I mean, the cuts will not be deep. I think we say that it'll be shallow cuts. We're expecting up to 1%, 1 percentage point reduction, which takes perhaps the policy rate to around 7.25% by the end of the first quarter of next year. But we wouldn't expect to see interest rates, let's say, at the levels that we saw into the pandemic, 3.5. That was the lowest level you have seen in a while. But you are getting back to levels of around 7%, which was also pretty much levels pre-pandemic, somewhere between 6 to 7%. It's possible to see 7% or lower if inflation does go closer to 4% than to 4.5%. So it is possible, but probably not that deep.
Another interesting one, I think you've also might have heard of this, Tatonga, our central bank wanting to target inflation at 3%. Many thinking that there's no use to this. I'm wondering, from your perspective, would lower inflation targets, just be better for South Africa? And even in future, should we have a bout of inflation again, would a lower target help us land better in those circumstances?
Absolutely. I think there is no substitute to lower inflation because it ends up providing lower cost of living. There are many places with inflation targets that are higher and you get inflation being higher. So one needs to work through getting a lower inflation target and also comparing with other emerging markets that target inflation also around the 3% level. So that is important, but I think there's still some work to be done before we get to a place of a lower inflation target, which is also dealing with issues around administrative prices, such as electricity prices that are still determined in double-digit levels. So there's work to be done. But as far as direction is concerned, I think it is important to take those steps of moving forward. Maybe it will take some time, but it is under consideration and something that can help to lower the cost of living.
Brilliant, Tatonga. Thank you for taking us through this information. I think very important for us, all of us crossing fingers for September. Thank you for your time. That was Tatonga Rusike, a sub-Saharan African economist for Bank of America's Global Research Unit.